Charter has seen its stock price really sell off in 2025, down 23.7. Oof, that's brutal. They've also suspended their dividend while they try to get the business back in order. They carry a lot of debt, and I'm going to show you that their debt is higher than the intrinsic value of free cash flows, which is the only stock I've seen in a long time in that very weak position. They're a $40 billion market cap company. These guys had a strong cable business, but cable is no longer a viable business. Everybody's streaming now. Everybody's on YouTube or Netflix. And these guys just were caught in the wrong business at the wrong time. The revenues are $55 billion. And incredibly, that's been kind of a pretty stable level. It's not like it's collapsing. The PE ratio is really low at 7 for the current year and 6.5 future years. Analysts think there's a big discount. Well, I'll give you my opinion on that in a few minutes. This was interesting that their revenue isn't collapsing, but you would think that it is because I just hear a lot of bad stories about Charter, and it makes sense that cable is on its way out. Charter does have broadband businesses, and they do have a mobile phone service as well for customers. So they're trying to compete, trying to get new categories of products within their particular industry. Cash flows have not been as consistent, and they have not grown like its peers. And that is a liability for them. Gross margin looks okay. It's a little lower than the peer companies. They are profitable. That looks good. What are analysts thinking? Why do they think this one is discounted? We've got 15 analysts weighing in. The stock is beaten down, so they think it's probably going to rise at some point. Revenue is going to grow just slightly, but they're going to hold that revenue line. It's just going to keep getting a little bit bigger year after year. And profits are going to grow nicely, double digits for a couple of years. That looks pretty good. And PE is really dropping. Geez, down to 4.99 in 2028. That is incredible. Charter carries a lot of debt, $96.2 billion. In proportion to the present value of their cash flows, they actually have more debt than the present value of future cash flows. That is not good from any angle. That means that they're going to have to dedicate their business to paying off debt for a long time. These guys are going to be in the doghouse. They're going to be suffering, and so are their investors likely for many, many years. Because even if they perform really well, they've got $96 billion of debt weighing on their shoulders when they can only produce a little more than $4 billion per year. It'll take them forever to pay that debt. So the market cap is $40 billion. But the equity value of cash flows is actually negative by over 13 to the negative billion dollars. So this one's all upside down. This is not investable. I do not like to put my capital at so much risk. I would be willing to do it with a small cap that had a great idea, but not a business that's just been beat up and left for dead. The earnings per share does look better. And this is why I do free cash flow estimations, valuations, and earnings per share, because they could really tell you two different stories. And this story is scaring the heck out of me. And I would stay away from Charter. Combined, it's a negative 74. And I just don't want to buy into a stock that's a pile of problems and it's just going to be a trail of tears, so to speak. I'd rather go find the next great company that is going to rise and really make my investment appreciate.